Good morning, everybody. Thank you so much for joining us today. This is the Mortgage Quality Compliance webinar, and my name is Marty Allred. I'm Vice President of Compliance with American Pacific Mortgage Corporation. We have Dustin from the California MBA also on the line, helping us with the webinar today, so thank you, Dustin. And we have a lot of participants joining today, so thanks again for joining us. It's always really exciting to see so many participants on these calls. The MQAC committee has planned some really great webinars and topics for 2018, so please keep coming to them, invite your friends and your colleagues. They are free webinars to attend, so it's always great to get this information and be in the know and be able to ask questions and get information from all your colleagues. Before we begin today, I would like to invite everybody to the California MBA's annual Legislative Day in Sacramento on March 12th, and you can register for that on the CMBA's website. That's www.cmba.com. Again, that's in Sacramento on March 12th, and that's Legislative Day. So please take a look at that, check your calendars. It's great to be active and involved in these matters. It's really important for you to come out if you can make that happen on March 12th. So we're going to go ahead and get started. As always, we have a legislative update and then a legal update. And our legislative update comes from Pat Zenzala, who's our California MBA lobbyist with KP Public Affairs. Pat?
Thank you, Marty. So just before I talk about specific bills, I want to let folks know where we're at in the legislative process. Friday was the deadline for introduction for bills for this session for 2018. So we saw just about 1,000 bills introduced in the last couple of days by the deadline. So we're quite literally in the process of reading every bill and developing our analyses as far as impact on the mortgage industry. Today we're going to talk about 3 of the bills that we've identified of interest, and there will be several more by the time we have our next call. So Dustin, if you want to go to the first bill I want to mention is AB 2368. This bill is actually in what we call spot form, which means it doesn't really make substantive changes, but it kind of holds a place in a section of code where we expect to put more substantive language in on a future date. But it's going to be intended to deal with the issue of remote notarization. We've seen legislation move in some other states. As an example, Nevada and Texas are 2 states that have recently passed remote notarization legislation. The California MBA is working with industry members that are interested in this topic. We're working with the Title Association in California. We're working with the California Bankers, with Land Title, with the Notaries Association, and several others to see if we can come up with essentially a statutory framework to allow for remote notarization in California. So that's definitely of interest for our membership. Next bill that I want to talk about is SB 818. This is a bill that was introduced in January at the very beginning of session. And this bill would reinstate several provisions within the California Homeowner Bill of Rights that sunset at the end of 2017, and more specifically, it would reinstate the more dramatic or the more onerous provisions that apply to entities that have had over 175 foreclosures within the prior 12-month period. In many ways, it overlaps with requirements at the federal level as far as rules, but there are some that would be unique to California if they're reinstated. And then the final bill I want to mention briefly is SB 1201. This is one that was just introduced at the very end of the deadline for introduction, so we're just reviewing it as we speak. But basically what it would do is it would require supervised financial institutions making mortgage loans to provide a translation of any modification of those mortgage loans if the negotiations were done in one of the 5 specified languages: Spanish, Chinese, Tagalog, Vietnamese, or Korean. And it would require the Department of Business Oversight to provide a essentially translation of 3 federal documents to essentially accomplish the translation requirement that the bill would provide. And specifically, those 3 documents are the Good Faith Estimate Disclosure Form from the U.S. Department of Housing and Urban Development, the Loan Estimate Form from the Consumer Finance Protection Bureau, and the Closing Disclosure Form from the Consumer Finance Protection Bureau. And essentially, the DBO would provide translations of those documents, and they could be used as boilerplates in meeting the requirements of the bill. So those are the 3 bills, Dustin. Thank you. And with that, I'll move it to the next speaker, which I believe is Michael.
Thank you very much, Pat. Morning, everybody. It's a privilege to be here as always. And I wanted to just briefly talk about a case that some of you may have been familiar with. We talk about it all the time. It seems like the never-ending case, PHH Corp versus the CFPB. There's been a whole long checkered history of this case. And but on January 31st, less than a month ago, the District of Columbia Circuit Court of Appeals, acting en banc, that's how they describe it, which means the entire panel of judges in that circuit, issued a decision in that case that basically overruled an earlier decision of a 3-judge panel at that circuit level, in part, and affirmed it in part. And it's an interesting decision. It's 250 pages long and consists of a majority ruling and then several concurrences and several dissents. But the ruling was 7-3 by that panel. So I'm trying to see here. Dustin, could you advance the slide? I can't seem to find the control. Thank you. One of the things that, I've listed the things here that this decision does, and some of you have been following it. Basically, the case arose out of a dispute over RESPA Section 8C involving the whether or not payment of reasonable value for services constitutes a kickback for purposes of the RESPA Section 8 prohibition on that. And Cfpb took a position in the case that was contrary to long-established tradition and understanding of those provisions, and it was challenged by PHH and in the courts, and ultimately we end up with this decision. I'll explain a little bit more how we got there in a little bit right now, but this is the summary of the decision. It reinstates the earlier 3-judge panel decision that captive reinsurance agents arrangements are permissible as long as the mortgage insurers pay no more than the reasonable market value. That was the initial core of this. Well, what happened was when it finally got to the 3-judge panel of the DC Circuit, they made a decision supporting PHH's contention that the CFPB was unconstitutional, and but that part has been overruled by the 10-judge panel. Another part is that the CFPB has taken the position that the statute of limitations, that there's no statute of limitations on administrative enforcement actions, and basically the lower part of the DC Circuit said, yes, there is, and agreed with that. So, next slide. This is the background through which it came up. In January 2014, the Cfpb filed its notice of charges against PHH and basically said that the payments that were being made, the reinsurance payments, were not for services actually furnished or performed, grossly exceeded the value of the services, and were made in consideration of referrals. The administrative law judge determined that RESPA had been violated. And remember, the administrative law judge was basically within the Cfpb. I mean, that's just how the system is set up under Dodd-Frank. The premiums were not reasonably related to the value of the reinsurance services, and then Director Cordray basically took a position after the administrative law judge had ruled, basically finding that the administrative findings supported an even broader finding of misconduct, and increased the amount of the penalty that had been recommended and ruled on. Next slide. He said that the 3-year statute of limitations under RESPA did not apply to agency actions, and that every single time a monthly premium was paid out, a RESPA violation had occurred. Well, this was appealed to the DC Circuit 3-judge panel, and this is where they came up with the constitutional ruling that basically said that the provision in Dodd-Frank that essentially provides for the dismissal of the director only for cause violated the constitutional separation of powers. And the applicability of the 3-year statute, they said category insurance were permissible as long as it was for reasonable value, and even if his finding was otherwise permissible, he had inappropriately and retroactively reversed a prior government position, which I thought was an interesting analysis in that regard. Next slide. So we're at this situation where, as I had indicated before, part of the DC Circuit's, the 3-judge panel of the DC Circuit has been sustained. The constitutionality arguments and decision that the 3-judge panel had indicated applied now don't apply. But at the present time, unless this is appealed to the Supreme Court, and I don't have an answer on that yet. Maybe if somebody knows, they can say. But as recently as this morning, I checked and was not able to find any evidence that it had been appealed to the Supreme Court. And as you know, it's up to the Supreme Court to take it. Just appealing it to the Supreme Court doesn't automatically make it go there. The Supreme Court has to take it on and agree to take it on. As of right now, the law on the land essentially is that the traditional understanding of RESPA Section 8C involving the payment of reasonable value for services stands, is in place. But so is the Cfpb, and its constitutionality and the structure of its director are in place. There's a 3-year statute of limitations on agency actions, which I think is a laudable situation and certainly beneficial to the industry. And then I've included this quote just to get a sense of how sort of charged this whole area is. And I'm not necessarily going to read the whole thing, but basically, this is what the majority opinion said, that the PHH's challenge is not narrow. It claims that independent agencies with a single leader are constitutionally defective while purporting to spare multi-member ones. But the constitutional distinction proposed by PHH is not tenable. And they say the distinction finds no footing in precedent, historical practice, constitutional principle, or the logic of presidential removal power. And I'm not going to read the whole thing, but what the essence of it is that the 10-judge panel en banc of the DC Circuit basically reinforces this notion that there are such things as independent agencies, and that which is a growing trend right now in our government, and where that's going to end up, it's not clear. So that's why I report this is still an important case to watch. If it does get appealed to the Supreme Court, it will be a very important case for our industry. Thank you very much, Marty.
Great. Thank you, Michael. Appreciate your litigation update. That, of course, is a huge case that we've been following for at least a couple of years now. It's always great to get an update from you on that, so appreciate that. And also thank you to Pat Zenzala for the legislative update. Seems like there's potentially some big things in California that could be coming down the pike, especially with the e-recordings and the foreign language implications. So thank you both very much for those updates. So we're going to get into the main topic for today's webinar, which is HMDA 2018 implementation. And we really designed this topic to be kind of the okay, now what portion of HMDA, because obviously it went into effect on January 1st, and we've all been working on it, since then, live. And we have two great speakers today, one who is more of a street level from the lender perspective, and then one who's software, a different perspective from that side. So we have Debbie Treseder, who's a senior compliance specialist with our company, American Pacific Mortgage Corporation. And Debbie is in charge of our HMDA data, our call reports, our fair lending analysis, among a host of other job responsibilities that she has. But she's been in banking and mortgage since the late 80s. She's held several positions as a vice president of compliance and CRA officer for several different banks. And we're just lucky to have her on our compliance team here at American Pacific Mortgage. So she's going to kind of give the lender perspective on some of these HMDA questions and issues. And then we also have Leonard Ryan. And Leonard has been associated with the mortgage industry for over 30 years. For the past 23 years of being with a major compliance software leader. He's the founder and current president of QuestSoft. He's also a frequent speaker at mortgage software and regulatory compliance conferences. Mr. Ryan's been named twice to Mortgage Professional America's Hot 100 list of mortgage superstars this year and in 2016. And in January 2017, he received a Vanguard Award from Housing Wire magazine. And he's also recognized as an MBA Tech All-Star for his visionary work in the area of mortgage and lending compliance. His company, QuestSoft, has received over 20 awards over the past 4 years, including Top Innovator for its line of compliance products. And QuestSoft has also recently ranked the 10 best small business workplaces in Orange County, California. So, wow, some very prestigious awards and decorations there, Leonard. We're very excited to have both you and Debbie on today's webinar. So Leonard, I'll let you go ahead and kick it off.
Okay, thank you very much. And welcome everybody to the meeting. There's been a lot of information that's been going around. A lot of people have been submitting their HMDA to the Cfpb. So the first part that I wanted to get into, Dustin, if you can advance to the next slide, is the issues that it says as of February 8th, but basically all these issues are still issues as of today. And as was said earlier, what we wanted to do was to focus this webinar on what things are happening out there in the street still. So the first thing is, if you happen to be a person on this webinar that has not submitted your HMDA yet, the one thing that I can recommend for you is the CFPB's process is totally different from the FFIEC process. And if you went out to do testing prior to 2018, prior to January 1st, you have to establish an account with the CFPB. Sometimes there's glitches and issues associated with establishing that account. So given that March 1st is only a few business days away, I would really highly recommend that today, if you have not submitted yet and you have not established that account, that you make sure that you establish that account so that when you do submit several days from now, the account is active and able to receive your submission. So that's my one big difference. The other difference that you'll have in your submission is the CFPB's intent is to start publishing this information far earlier than in the past. They want to get this out in April of this year. And so they've automated the process. So you will not receive that note that you usually get, the report, and then you have to sign off. All of it is done online. And I think actually the process this year is a better process given that you go through all of that at one time. So that's my recommendation in terms of this year. So let's talk about the new year and the new CFPB HMDA. There was a lot of people have talked about the note that basically the CFPB put out on December 21st. And so one of the things about that, it's been interpreted a number of different ways. And in talking with the CFPB, knowing in general what they're looking for, the thing not to look at is that there's a free pass somewhere in here. There really isn't a free pass. What there is if you're making a good faith effort to get the job done in terms of getting the new regulations up and running in your operation, and there happens to be some issues between the vendors and your software or internal processes, the CFPB just isn't going to immediately come down on you. The good news about HMDA is that we don't have the quarterly reporting yet. It's still annual reporting. It's still the way that it is done today, which is you're supposed to collect the information, review it every quarter, bring it up to date within 30 days of the end of the quarter, keep it on your side, and then submit it at the end of the year. So because it's a post-event regulation, unlike TRID and a lot of other regulations, the good news for everybody is that you do have time to get it right. And so I do highly recommend on everybody's side that you just work through the vendors and you keep the same notion of HMDA that you always have, which is it's supposed to be done on a quarterly basis in case there's in case you have an exam or some other area like that. So one of the big issues that we hear about at the moment on our side, you're basically going from under the old HMDA, you had 62 validity errors and you had 28 quality edits. The new CFPB HMDA has 215 validity errors and 42 quality edits. So the biggest issue that you have is that you have 2.5 times the number of validity errors under the new expanded data. And that makes logical sense since you're going to so many data points, basically from in the 40s to 110 data points. So it's real important. You've never scrubbed this data before. And it's very important to, I would look at it from the point of view of, you know, the old adage of how do you eat an elephant, one bite at a time. I would take individual areas during the next quarter, during the next half a year. I would take individual areas that have not previously been scrubbed, and I would take and audit those particular areas. So maybe take 5 of the fields at a time and go through and see how your procedures are working internally, making sure that everything is going right. The other thing is that there still are some of the LOSs that are adjusting their systems, and they're adjusting their systems based on how you're using the system. So starting this off after you get your 2017 HMDA out of the way, doing some practice runs and kind of working this through before the quarter hits might be a good idea for the purpose of making sure that everything is lining up. I have heard, for example, some issues, especially with the multi-spouse. It's kind of a traditional issue. You have a 1003 or a EURLA that has a borrower and a co-borrower on it, or a borrower and spouse. You have a non-related or non-spouse co-borrower that's on a different form. There have been some instances that we've seen where those have not been coming over on the race and sex issue. So do check on those. Do keep track of that type of thing. The other area that we're seeing a lot of concern about is in regards to generation of the universal loan identification. And I'm going to assume for the moment that most of you have, at this point in time, have gotten your legal entity identifier, or LEI. If not, we can address that at a later time, or I can address that separate from this webinar. But the ULEs, some of the areas that people have some issues with is, number one, if you have multiple LOS systems or you have multiple lines of business, you have to give a little bit of thought in advance about what those numbers are going to be, because the numbers are never to intersect with each other. And one of the ways that we've looked at that for our customers has been to, after the LEI, to establish if you're using multiple LOS systems, or you have, let's say, HELOCs in one system and you have your first trust deeds in another, is to establish a single or two-digit code that you put in front of the loan number, and then that way, if that can never happen. And so that's one of the things to take a look at. A number of people have also asked us about batch processing of universal loan identifiers. I don't know how many LOS systems are going to be doing that. I know that in our particular case at QuestSoft, we are with our software. We're going to be introducing that shortly for those situations. The other instance is who's supposed to assign the LEI. So whoever is the entity that makes the credit decision is supposed to assign the LEI. Now, one of the things that makes the new HMDA different is that, or ULE, excuse me, is supposed to assign the ULE. One of the things that makes this new HMDA different is that sometimes in the past, because you didn't have a loan ID that was following the loan from basically birth to death to final payoff, you didn't have a situation where two people, you didn't have a situation where if somebody submitted HMDA and another entity submitted HMDA, you never kind of figured out that it was the same loan. So we would have instances where people felt that they were supposed to submit HMDA, and then the people who were funding the loan were submitting the HMDA. It's real important that this distinction of non-delegated versus delegated be worked out. If you are a non-delegated underwriting and you have to send that loan on to be underwritten by your investor, that means that you probably don't have a HMDA requirement for funded loans. You may still have a HMDA requirement for the loans that don't cross the finish line, but you might not have one, and you probably don't have one for the non-delegated underwriting loans. So if you're doing non-delegated underwriting, you might be in some trouble if you're thinking that you report the good loans, the ones that get funded, because that essentially will probably be the job of your investor. If you are a delegated underwriter, then you are making the credit decision. So that's one of the areas that we've seen. Another area that we've seen some issues in is what numbers to report in terms of loan amounts. It's real easy to figure out closed loans. Closed loans is whatever you funded, right? But counteroffers draw some distinctions and make it a little bit more difficult. So, or other things, so approved, not accepted, etc. So if they accept the counteroffer, then it's the amount of the counteroffer. If they don't accept the counteroffer, then it's the amount applied for. And so again, your LOS systems should be adjusting for this, but they may not be adjusting initially. So you need to watch out in terms of on your side for those type of issues. Approved, not accepted, it would be the amount that was approved for. In the denied, withdrawn, closed for incompleteness, you go back to the original amount applied for. And so those are things to, like I said, be aware of as you're going through this. Purchase loans, it's the unpaid balance, not the original amount of the loan. Assume loans, same type of thing. Open-end lines of credit, the amount of credit available. And on reverse mortgages, it's the initial principal limit. So those are things to, like I said, watch out for. In regards to another issue is that we have this new concept of relied on, and also the automated underwriting systems and their new classification of used to evaluate. In regards to the issues of what was relied on, credit scores, average income, debt to income ratios, the LTV. It doesn't matter what your system says. If you guys have a yellow piece of paper off to the side and something gets written on there and that's what you use, somehow that needs to end up inside of your system. The other issue is that if you are doing the underwriting, but then you're sending it off, and in the process of sending it off to the investor changes something, then you better have that. Then that change also needs to be reflected on your side. So watch those type of things. Those are types of issues that we're seeing as we're going through. In regards to the automated underwriting systems, there is a certain waterfall. Those you can find on Cfpb information that's on the Cfpb. My company, I'll promote it just because it's free. But in our particular case, if you go to our website, QuestSoft.com, we have an area that's called HMDA headquarters. If you go into that, there are all kinds of free information in regards to submission, in regards to the automated systems waterfall, in regards to these type of things. There's also several webinars that were free that were conducted with several of the people that were at the CFPB when this regulation was taken care of. So you can take a look at those. But the AUS waterfall, especially, for example, if you're doing an FHA loan, you did something through DU, but what you used to actually evaluate with a FHA scorecard, then those may not be in the right alignment in your LOS system. And so you do need to take a look at that as you're going through. In regards to changes, I'm going to deal with other issues in a moment, but in regards to the 2019 changes that we see, there's been a lot of talk about what will be rolled back. Mick Mulvaney wants to go ahead and do all kinds of new things with the agency. What the initial information that's kind of come out, the information in regards to the fair lending department not being separate, now being put into the supervision side, in regards to the general supervision that's taking place, the issues that I've seen have been regarding privacy. The things that are being discussed are because the privacy stuff has not been made into a final rule. And there's some talk in regards to whether or not you go to what is publicly made available today, or if the CFPB is going to release a lot more data. The advantage of them releasing more data is that that will allow for a database essentially to be created where if you're looking at fair lending issues, that you actually for the first time will have something to compare with. The same thing happens on the Community Reinvestment Act side where there's actually some comparable data. So there isn't all bad by going with this new, depending on what's released, there could actually be some good in terms of defending yourself on fair lending issues, depending on how this all rolls out. But the new information does lead you into a situation where you do have to watch out for potentially more information being on the street and more community resources, the community groups taking a look at that and attempting to use it against you. It is definitely true that under the new CFPB rules and the new HMDA, with this additional data, the different regulatory agencies and the state regulatory agencies and the CFPB and the federal regulators have all entered into a data sharing agreement for the information. So it is possible that if somebody is looking for fair lending issues, again, that will be very automated under the new system that's out there. In regards to other issues that we're seeing in the field right now, which is on the next slide, Dustin, the issues that we're seeing is, number one, don't even remotely think that the validity errors that you've used up until today with 2017 and for the last 10 years, they don't have any reference at all to the new numbers that are under the CFPB HMDA. The CFPB HMDA has a lot more errors, And one of the things that they did when they created these new validity errors is that under the old HMDA, you had basically a specific condition that created a specific error. And under the new HMDA, even though companies like ours and some of the other companies that are out there, or maybe even some of the LOSs, have tried to keep that balance of one issue, one error, the new errors actually kind of say that your problem could be here, or it could be this other area, or it may be even this other condition. So there's multiple conditions, and that seems to be causing some problems. Another issue, duplicate universal loan identifiers. It is possible to have a duplicate ULI. Everybody thinks of this as a number that's only used once, and for the most part that is true because it is only used once on a particular loan. But there's always the possibility you may be submitting it 2 or more times, and where that's going to happen, the exception that you have, is let's say you fund the loan and then that you sell that loan. 3 months later, the loan comes back to you in terms of a buyback. You then would have it issued twice, once as a purchase, once as a origination. It could come back to you in terms of a pool of loans. So that's the reason why the duplicate ULI is only a quality error. We've already talked about some of the other differences here in regards to companies, the legal entity identifier. Again, that's something that takes several days to get, so I would recommend it. If you have a bank or credit union, you likely already have it. Another issue that's been brought up has been the geocoding and safe harbor. In regards to geocoding, the Cfpb has not put out a geocoder yet on their side. They basically extended the FFIEC geocoder. The difference that you have in the way that the Cfpb is looking at things and the way that the FFIEC looked at things is the FFIEC was looking at a per loan basis, and they went out and licensed what we call enhanced data. So just like our company and other companies out there may go ahead and pay a third party that goes out every day, like Navtech or TomTom, to go and give a higher quality of data. In regards to that, the FFIEC also had done that traditionally. Under the new CFPB, but they haven't updated it in at least 6 months. So it is becoming older data at this point in time. They were not intending to renew that contract and to update it. So as time goes on, that may become a little bit of a problem for folks. Under the new CFPB geocoder, they're looking to use free resources. And free resources, basically, the problem that you have is not in the middle of the census tract. The problem you always have is right along the line. And there may be some issues with that. As a result, they issued a safe harbor if you use their particular geocoder on that particular item. Another thing that they said in the commentary in August of last year is that other entities or other geocoding can also be under the safe harbor. The thing is that CFPB isn't going to issue it, but they can be under the safe harbor as long as they use standards that are equal or higher than the standards that are going to be used for the CFPB. So that is one of the things. If you have existing vendors or things like that, most likely those vendors are going to be looked at that way, although the majority of them, including us, are going to be looking at the CFPB geocoder also. If you don't have a HMDA LAR, if let's say you no longer have to do a HMDA LAR, or if you're a wholesale lender that works with somebody that doesn't have to do a HMDA LAR, that's going to be another issue for the ULIs. So just keep that in mind. And the final thing that I wanted to talk about before I give it over to Debbie is errors that are associated in the supplied tools. When the CFPB issued the rate spread calculator, the difference between the new rate spread and the old rate spread is under the new rate spread, there is no longer thresholds. And so the other thing is that the CFPB calculator is different from the FFIEC calculator. It rounds and truncates differently. So if you use each one, they actually come out with two different numbers many times. So for 2017, use the FFIEC rate spread tool. For 2018 and beyond, make sure to use the CFPB supplied tool. And then in addition to that, there's been other technical issues, but my guess is based on responses that we've seen from the CFPB, that very shortly that those will be corrected. So again, be aware that as the CFPB comes out with things, that they're not always perfect, and that sometimes there needs to be some adjustments. They are making those adjustments, and most of the LOSs and other vendors are working along with it. So with that in mind, I'm going to go ahead and turn this over. Debbie, go ahead and take it from here.
Thanks, Leonard. Hi, this is Debbie. I just first wanted to tell everybody that if you have any questions, you can type them into the question box, and Leonard or I or whoever you direct the question to will try to answer them. We did get some advanced questions from people, and Leonard and I are going to answer those questions after I talk. But please type in questions, and we'll try to answer anything that you have out there. I'm going to talk mostly about the demographic information. In our shop, we've been getting a lot of questions about this. Quickly, this is the general demographic information page. We are telling our people to let customers fill this out as they wish. They can check everything, they can check nothing, they can check the other and leave the thing blank, or they can enter some data there and not check the other key. We're really trying to get people to fill this out as the customer wishes. In fact, we encourage our people to give them a copy of this if they're sitting in front of them so that they can look over it. I think it's easier than spewing out every single option and that, so the customer can look at it and fill it out or tell the LO what they want him to check or fill in. We even encourage them to email it to the customer if they're going to have a telephone conversation. Obviously, on the internet, it should look pretty much like this, and the customer can choose to do what they want. Something that comes up all the time about is the 2017 to 2018 transition. If your loan was started in 2017, you are collecting the 2017 information, and that should switch right over in, even though it'll be on the 2018 form, at least that's how Encompass works. It'll be on the new form, but it will still only be the 2017 information, and that is all that you need to provide. In fact, that is all you're allowed to provide. So you don't need to go back to your customers and ask for the additional information if the loan was started in 2017. And the other thing is that, no matter how many things the customer chooses, we are only reporting the first 5. So I believe our reporting is the aggregate information first, then the other boxes, and then going straight down the line with the disaggregated information. Other people may have chosen a different order. The regulation doesn't prescribe an order, except that aggregate information has to be first. Let's see, another issue that comes up a lot in our shop is if the customer fills out an internet application and they skip all this information, or they skip one section of it, and then later the LO is talking with that customer face-to-face, then the LO is obligated to go back and ask the customer for this information and to complete it if the customer refuses, based on visual observation or surname. However, if the customer actually checked, I do not wish to provide this information on any of the sections, then the LO later meets with them face-to-face. The LO is not obligated to go back and ask the customer for the information, and they're not obligated also to change it to face-to-face and fill it out themselves. I think the thinking on that is, if the customer skipped it, they may have just missed it. But if the customer actually says, I don't wish, then why are we going to annoy them by asking it again when they already said they don't want to provide the information? So that's a little bit different from prior years, and actually I think it's quite a bit nicer. Remember, another issue we have is that if it's face-to-face, then they have to tell, the LO has to tell us whether the customer filled out each particular section or whether they filled out the section. Down here in the to be completed by financial institutions. So you have to say whether the LO provided the information, or you have to say whether the customer provided the information in a face-to-face application. So we can switch to the next page, Dustin. This is something that I found that may be helpful to people. The most questions I'm getting these days is from LOs who don't know how to fill this out, and actually their customers don't know what to choose. You know, if a Hispanic customer chooses ethnicity Hispanic, and then they're saying, hey, none of these races apply to me, you know, the LO's like, what do I do? Or we have people who say, you know, I'm French, I'm Dutch, I'm whatever, Brazilian, or, you know, I don't have a place to put whatever, you know, what I want. So that's making customers mad, I think, a little bit. And our LOs are concerned because if they have to fill this out and then the customer sees it at closing or at, you know, wet signing or whatever, and it could cause some issues if the LO is not correct in what they said. So we've given this to our LOs, and we encourage them to give it to customers who are questioning all these different sections. You know, for example, let's see, if you're from Pakistan, you're listed in the Asian section here, but for the most part, Middle Eastern people are considered white. A lot of the customers that we have that are Middle Eastern don't want to consider themselves to be white. So what I always tell the LOs is, first of all, let the customer choose what they want. If they want to put that they're French in the Asian other section, I don't care. You know, whatever they want to do. If they don't want to fill out race because they think the ethnicity serves as all they need to do, that's okay. Everything's okay. And this is just additional guidelines that the LO can use when a customer is unsure of where they should be placed. Because from what I've read about race versus ethnicity, ethnicity is really supposed to be the place. It's kind of a place thing. I'm Dutch. Somebody else could be French. Somebody else could be Brazilian or South American or whatever. And then race is supposed to be more about your physical characteristics, your skin color, your eye color, your hair color, that kind of thing. However, all the research I did said they use them interchangeably all the time, and it's apparent from the way the government aligned this, that they are using it differently. You know, the ethnicity seems more like a race, and some of our races are more like ethnicities. We're obligated to fill this form out in the way that they gave it to us. We can't really change it, you know, and so we're just encouraging customers to fill it out the way they want to fill it out, and for the LOs to do their best if they have to fill the information out themselves. And actually, this is another reason why an LO should use their good sales skills to encourage the customer to fill it out themselves so that they don't have to guess. I know if an LO told me, you know, either you fill it out or I have to guess, I'm not really into guessing. The customer's like, okay, I'll do it. You know, so that's, you know, that's a sales skill, I think, that LOs may be developing a little bit more now. I'm going to switch over into a couple of questions that I got, and then I'll hand it over to Leonard to answer a couple of questions. And then if we have any other questions that have been typed in, one of us can help out with answering it. One question we got was about the poster requirements, and should we keep the old poster up? It's pretty ambiguous in the reg, but I just don't see any reason why we should have two posters up in our offices. It's confusing, conflicting. So we are just putting the new poster up, and I think that would suffice for most of you. I can't see how that could be a big problem. The second one is, how do we handle reverse mortgage reporting under the new rules? You know, the bottom line I have to say is, you have to report them. A lot of our reverse mortgages are non-delegated, so we don't report the non-delegated loans. but everything else we report. There's also some data points that because the loan is a reverse, we don't have to actually complete that data point. And of course, there's some that are a little bit different. I know loan amounts a little bit different and some other things. So you basically need to report your reverse loans unless they're non-delegated. Let's see, some of the fields you don't have to report are HOEPA, the term, the prepaid penalty, the spread, some of the costs fields you don't have to complete, and then others you do because the reverses are still on the old GFE form. Let's see. If they're open-end and you're under the open-end threshold, then you wouldn't have to report any open-end reverses. I don't know what specifically this person was asking, but that's the general reverse rule. And then the third one that I got, what are the exemptions for open-end reverse mortgages? Basically, for 2018 and 19, they're excluded if you did not originate 500 or more in each of the 2 preceding years. In 2020, that number drops to 100. I don't know if you guys have read the new Getting It Right that came out. I've only gone a few pages in, but I did see that already there's a conflict on whether it is in each of the 2 preceding years or either of the 2 preceding years. One section, I looked in there, one section it says each, and one section it says either. You know, we don't have this issue because we're definitely a reporter on regular loans, and we're definitely not a reporter on open-end. So it's not something I've dug deeply into, but there is some conflict, and if you're on the edge, you might want to, I don't know, talk with legal counsel or read the reg a little bit more carefully. And with that, I'm going to send it over to Leonard for some more questions. Thanks.
Thank you, Deb. Thank you, Debbie. So a couple of things on the each or either issue. The CFPB had originally come out with each. There was rumor that they were going to switch it to either. They kept it at each. Then now you're saying that the guide may have an error. So traditionally it's been each, and that was what was kept as far as we knew. So there was no update on that. But as Debbie mentioned, I believe it was yesterday, the HMDA Getting It Right guide came out. That was totally unexpected on my side because for all the events that I've gone to when the CFPB has been there, they had indicated that they were just going to stay with the 1,500 pages of guidelines, and that had enough examples in it, and everybody should be happy with that. I guess somewhere in translation, it got placed into a new 325-page 2018 HMDA Getting It Right guide. So that is available now for you. And that's also one of the reasons why a couple of these questions I almost wanted to check the guide to see if there was something that was changed in that. The other thing I was going to just comment about on Debbie's side was she was talking about GMI information. We had a funny moment, and during HMDA hell and the submission time, we look for those moments. But we actually received somebody actually had a loan file where somebody voluntarily went to the other area and said Texan as their choice for the race, sex, and ethnicity. So I guess that shows you a little bit of that independent spirit in Texas. The other things that I was asked, so some of the questions that I was asked was in regards to interest rates, if a lender originates a 0% loan as a junior lien, is that covered under HMDA? And it's covered under HMDA, but does not fall under TRID disclosures. What would the lender report? In regards to the ways that loans get reported, the only thing that doesn't get reported when you don't fall under TRID disclosures are the areas of the loan costs themselves. So the points and the fees that are associated really only aligns with the TRID disclosures, and if it's not a TRID disclosed loan, then under the new HMDA, those basically get set to NA. We have seen a number of the LOS systems that are having issues with this particular area because a number of them only have numeric values for loan amount, which makes total sense, right? So they reported 0 across the board, and then we have to manually take a look at that and go, wait, hold it, this was really supposed to be an NA, which is allowed in the field. So just in regards to that, that's one of those things. The other question I was asked was, how will the new requirements impact analysis for the fair lending? And I went through that in the sense that it's a difference in the way that fair lending, it's not necessarily that fair lending is going to be different in the way that it applies and its way it's looked at. It's that all this stuff is available automated. So if you think of traditional fair lending, what people would do would be to take the HMDA data and they would sense that you had some smoke, you had a potential problem. And then the regulators would come and they would ask you for this additional data. A lot of times it's called a HMDA Plus file, depending on who you're talking with. But they would ask for this additional data, and then they would do their fair lending analysis from there, and then it would be up to you to defend yourself. The other thing then is that community groups would try to file a lawsuit or request the information. So under the new regulation, that information is already going to the Cfpb and to state regulators and to federal regulators. So before they do an exam, they'll be able to figure that out. There's some good news again. If you're a good lender and you have fair lending kind of covered in a good way, again, you'll have a defense because other people will have information that you may be able to gather and then show, wait, hold it, other people have the same struggles in this particular area. The other thing is that since this is being done up front, and traditionally the regulators are kind of looking for 5%, of the people that are doing things wrong. And when we were talking to the state regulators, for example, they said that they wanted to do certain things with the idea that they could quickly just go through the whole thing, figure out who's the good guys and who are the bad guys, and spend more time concentrating on the bad guys in the industry. So there could be some good stuff that comes out of this. It's still to tell. We're still looking to see what is made publicly available. And I think the publicly available data is the most concerning, because so much of that can be linked back to an individual loan and the possibility that some of that information gets out. I already talked about some of the struggles with the information. So I think, given that we only have a few minutes left, I'm going to see if there are any other questions that you guys have over there that were asked by the attendees.
Okay. Hey, Leonard, I see one. The customer asked, they have a loan originated in December of 2017, but they're planning to close it in 18. Do you need to report this loan in your 17 report? No, this is not new. It's the same as always. If you report a loan when you decision the loan, not when you take the loan application. Are there others?
And I would add that there's one thing that kind of goes along with that. You have less information in 2017, more information in 2018. If you have a loan that's originated in 2017 that closes in 2018, the only optional information is the demographic or GMI information. That's the only thing that's optional. All of the other data fields have to be completed because you closed the loan in 2018. And on that one screen that you have, which asks the demographic information, it asks, was this race taken by visual? Was the sex taken by visual, ethnicity? There's 3 questions where there used to be 1. You have to, because you closed it in 2018, you have to answer all 3 of those questions.
Right. Justin, are there any other questions?
Yeah, we've got a couple others. So the question is, would the ruling of statute of limitations for administrative action 3 years determination for respite have any application to the California per diem rule violations?
Sounds like a Pat or.
Yeah, that's not a Leonard or Debbie question, so.
We pass.
Fair enough. All right. I'm not sure Pat's still on the line here, so I've got a couple more. I know we're running out of time here, so see if we can maybe blaze through a couple here. Does a repurchased loan need a new ULI? That is, you can't use the one you used to originate the loan?
I think
it's the
you use
opposite.
the same. Yeah.
That's correct. No, you use the one that was used the original, and that's the reason why it's a quality error and not a validity error when submitting your HMDA.
Okay. And then I've got one more here. If a lender funds a loan and then submits the loan to an investor and another AUS is run post-funding at the request of the investor, the lender would report the AUS it relied on to make the credit decision prior to funding the loan and not the post-funding AUS, correct?
That sounds right to me.
Yep, I would agree.
Okay, I don't see any other questions on my end.
Okay, great. Well, I want to say thank you to Debbie and to Leonard for this great information, very timely, and I think we answered some great questions from everybody. We're going to have a part 2 to this webinar next month. It's going to be the fair lending implications of the new HMDA rules. So please join us March 22nd next month for the fair lending implications of the HMDA 2018 rules, and we're going to have Angela Klein from Morrison & Forrester and Sharif Mundevian from Compliance Ease. So we look forward to seeing you on that webinar again. Thank you so much, Debbie and Leonard, and to Dustin for helping with the webinar today. Everybody have a great rest of your day. Thank you.
Thanks.